Hi everyone, Abdurrahman Adele is my name. The last video we introduced the concept, we introduced the topic financial management. And under it, we said we are going to be looking at, we said the major bottleneck in which most business organization or entrepreneur face is what is capital. A major bottleneck in which most of the business organization face. Now, what is what? Cost of capital. That capital, which is the bottleneck resources. After getting that capital, what is the cost attached to that capital? That's what we are looking at here. So, by definition, we said the cost of capital is the minimum required rate of return on the investment project that keeps the present wealth of shareholders unchanged. From this definition, you can see certain keywords there. Me attempt to do what to explain our own class, attempt to explain my own lecture, picking certain keywords to what in any division I see. That is the best way in order to do what to comprehend, to understand any topic you are treating. In this topic, under this topic, the major keywords, the keywords in this definition is what? Minimum. Required rate of return on investment, minimum required rate of return, minimum required rate of return on investment projects that keep the shareholders' wealth unchanged. Shareholders, let's look at shareholders too. Now, how can I identify the major words in this definition of cost of capital? What is minimum? When you say minimum means the least, means the smallest, the least. You can expect the least. Required rate of return. What do you mean by rate of return? Before you can be expecting rate of return, because you can be expecting return, it means you have invested, you have put an action, you have invested in a particular project before you can be expecting return from it, from that investment. Look at minimum required rate of return on investment project. You have invested, you are not expecting something from it. So the minimum thing you are expecting from it is is the minimum rate of return you are expecting from that investment is the cost of capital. So having invested in a project, cost of capital is what? Is the minimum required rate of return on investment. That is what you are investing from this, what are you expecting from this investment. The minimum thing you are expecting from this investment is what is termed as what? As cost of capital. That is, anything below it is totally out of it. But this, it must not go beyond. This is the what? You can also call this cost of capital as what? The cut-off rate. You can also call cost of capital the cut-off rate. It is the cut-off rate which keeps the present wealth of shareholders unchanged. Who are the shareholders? Shareholders are the owners of the company. It tends to do what to explain more on shareholders under this topic as well. The shareholders are the owners of the company who pool their resources together for the growth of the organization. And the resources, which is the capital in which they are pulled together, is not free. The company as an entity is taking that capital at a cost. Even in Freetown, nothing is free in Freetown. So this capital put together by these shareholders is not free, it's at a cost. So in investing on any project, therefore, they are expecting something from their investment. So for the company as an entity, before it invests in a project, it has to set a standard that any project that is giving us below this standard is unacceptable. This is the cut-off rate. Any project that is giving us below this, we are not going to do we are not going to do what? Invest on such projects. That is what we mean by what? The cost of capital. So it is a rate that will leave the shareholders' wealth unchanged. Now, having explained what we mean by cost of capital, now let's now look at the concept of capital itself. You have looked at the cost, that is the cost attached to that capital. But what are the various forms of capital, of raising money? And we say capital in this concept of financial management, can be, we are looking at capital in the long run. We have various sources of capital. We have short-term funds, we have medium-term funds, we have long-term funds. But our major concentration here in the world will be on long-term capital. So we have different forms. Say we have different forms. We have short-term, we have medium-term, we have long-term. So here, our major concern is working on long-term source of capital. And under the long-term source of capital, what are we talking about? So later in other subsequent courses, we shall be looking at the short-term and the medium-term. But now, under this source of capital, we are concentrating mostly on what? On the long-term source of capital. So under the long-term source of capital, it can be further subdivided into what? Into ordinary share, preference share, and what to debt, debenture, can call it debenture. Yes. These are the major categorization of long-term capital. We say we have ordinary shares, we have preference shares, and we have what? Debt, which is what we call debenture. All these are what are long-term source of capital. This long-term source of capital, as we have said, does not come free. It's at a cost. The ordinary shareholders are the owners of the company. The preference shareholders sometimes we have two schools of thought under the preference shares. There are some that say the preference shareholders are also part owners of the company. Another school of thought said the preference shareholders are not owners of the company, but they are creditors to the company. Why this? The debenture holders, they are purely creditors to the company. The ordinary shareholders will not receive any benefit from the company until all other providers of capital as enjoy their own benefits. Even if the company makes profits, the management of the organization tends not to pay them their benefit in terms of dividends. The benefit of the ordinary shareholders is what? Number one, they are the owners of the company, but their benefits, because on the capital provided by them is what? It stands as as dividends. Also, the preference shareholders, their own return to is dividend, rate of return. Their own return to is dividend. Why? The debenture holders, their own return is is interest. All these forms of owners of company have their return, which are expected from the company. So I was saying, this set of people, the ordinary shareholders, will not receive nothing until the preference shareholders and the debenture holders have been settled. They are allowed to be settled in the shame. In that, therefore, they are the real owner of the company. So what is the major dichotomy between ordinary shareholders and the preference shareholders? Some said the preference shareholders are also part owners of the company. Why? Because they too will not receive any benefit until the debenture holders have been settled. Also, they also receive a fixed rate of what to. So this number one is what the school of thought that said the ordinary shareholders, the preference shareholders are also part owners of the company. This is their own argument. The argument is that they will not receive, they also don't receive anything until the debenture holders have been settled. Also, they will not receive anything if the company does not make profit. Now, those are the school of thought for those people that said they are also what the owners of the company, just like what the ordinary shareholders. But the major difference between the ordinary shareholders and the preference shareholders is that even if there is profit, these ordinary shareholders may not receive any dividend if the companies have what viable project at hand. It intends not to do what, not to give them profit, in order to do what, to invest on those viable projects, in order to do what, to increase the market value of the company in the long run. And that therefore, some people say they are also what to, they are also part of the company. Some people say they are not part of it now because if the company makes profit, they will pay them, and also they also receive a fixed rate of what to, fixed rate of dividend, just like the debenture holders. That is why some people classify them as what, not being not what to, part of the company. I haven't introduced what cost of capital to us is now. In the next video, we shall be looking in depth into what to the long-term source of what of finance, which is capital. What are the costs of what to of this source of finance, and what to how do we now calculate their return to the ordinary shareholders, to the preference shareholders, and what the debenture holders. So at the end of the day, the aggregate summation of what of the cost attached to each of these, to each of the ordinary shareholders, preference shareholders, and debenture holders is what to stand as what as the cost of capital to the company as large. So the aggregate of what of all, summation of all is what is stand as what cost of capital to all. So we tend to do or look at it in depth in our next video. What is the return? How do we calculate the cost of capital to ordinary shareholders from the company perspective, to that of the preference shareholders, and to that of what to the debenture holders? So watch out for our subsequent video on what on detailed explanation for the long-term source of capital. Thank you.